Just wanted to touch base today on our investment philosophy. Realized it had been a while since we really had talked about it, so just wanted to address it. And the way that I'm going to do that is just to cite a couple of studies that some of you that have been around for quite some time might recall at least one of them. Not a lot of you will be able to remember the second one because I haven't talked about it as extensively. But we have an investment philosophy that we invest in broad asset categories around the world, and we favor being able to invest in the entire asset category because it provides us the most reliable results. There's some data that has been collected by third parties that have done a really good job of verifying that this approach is the best one, and I just want to tell you a little bit about those because it really helps me to make my point today. So the first one is the Dalbar study of investment behavior. It gets taken every year, and it basically compares the performance of the 500 big companies in the United States, otherwise known as the S&P 500, to what the average investor gets per year. They have various ways of collecting this data, and what the study has shown for decades is that the stock market on its own, those 500 companies is what we're using in the example, against the average investor does better to a very wide margin, multiple percentage points better. The reason that they found out is that the investor participated in one or more of the following: trying to time the market, trying to invest on a particular track record of a supposedly hot money manager, or they tried to actively buy and sell stocks. One of those reasons ended up being the reason why they so underperformed. So that's one study. The other one I find particularly interesting for a little bit different reason, and that's from Vanguard. Most of you have heard of Vanguard. It's one of the largest investment management firms in the world, and they track their individual investors who do their own investing separately from all the investors who invest through them with an advisor. So what they did is they did a very comprehensive study. They examined 5,000 IRAs that are self-managed, and then they compared those to the group of IRAs that are managed through an advisor. And what they found out is that the advisor-managed portfolios beat the individual investors who manage their own. They put a number to it. It was astounding. It was 3.3%. And the reasons that they found for the underperformance were essentially the exact same reasons that Dalbar came up with, particularly active trading. They found that in most cases, the investor who did worse as an individual investor handling their own money was because of one ill-advised trade per year. It's how pricey those things can become. So this is why we don't actively jump in and out of markets. It's why we don't time them. It's why we don't invest based on a track record. We use the track record of the overall markets. They do really, really well. And the most important thing they help us to do is when we program a certain rate of return for your financial plans, it has statistical reliability, which is what helps us to have such a really strong record of being able to have people complete their plans successfully. So, a little bit of update on our investment platforms, our philosophy for managing it. Please call if you have any questions. Thank you.